Welcome back to the Live Off Rents podcast by Spark Rental. As always, I'm your host, Brian Davis. I'm the co-founder of Spark Rental, and I am on a journey to reach financial independence alongside our audience members. We get together every single month. We vet different passive real estate investments. We go into them together, and we get to bring in lots of outside experts as well, both to speak to our co-investing club and also here on the podcast. So today we've brought in Chris Miles. He's the founder of Money Ripples. He's the host of the Money Ripples podcast. And he's been involved in infinite banking for some time as well, in addition to being an ex-financial advisor. So I wanted to grill Chris a little bit about what's hype and what's real in infinite banking, because, Chris, as you and I were talking about before we hit the record button, sometimes the infinite banking space, it can get a little guru-ish and it can, sometimes leave a sour taste in your mouth. So I'm curious to hear your thoughts. What are the pros and cons, the risk rewards, what's real, what's hype in infinite banking?
Yeah, there's definitely a lot of BS in infinite banking, that's for sure. Or I like to say a lot of BS in IBC, right? I
Yeah.
mean, because like for example, like when I quit being a financial advisor, I got in the real estate game. Everybody was talking about infinite banking. I had never heard of it. I was a financial advisor for 4 years, never heard of it before. They sent me the book, Become Your Own Banker by Nelson Nash. I
Right.
drank
The,
the
the Bible
Kool-Aid.
of infinite banking.
Exactly, right? Like
Yeah.
it's like a must read, and of course I'm like, okay, cool. So you use this to buy cars and houses. Got it. I get the policy, and I remember seeing the policy. And remember, I was insurance licensed even at that time. And I was thinking, like, isn't there a way to do this better? Because this is really expensive. And the guy says, no, if you try to put in more money or try to manipulate it, you'll get taxed. I'm like, well, I hate taxes, so let's not do that. So I said, all right, I'll go with it. Well, that was 2006. And as I've mentioned my story before, 2008, I was broke, right? Couldn't keep making the premiums. I paid 25 grand in premiums into this policy at this point, and I had zero cash value, zero in that tax-free savings account, which means if I stop making payments, it implodes. I lose it. It was like the most expensive waste of a term insurance kind of plan that I had that was like expensive term insurance, right? Because I lost it. I couldn't keep paying the premiums. I found out months later, the guy lied to me. And so I actually ran my own numbers. I sat down with him in his office for 2 hours, debated the guy. And here's what I told him, it's like, listen, if I would have done it this way, I could actually have cash from day one. I would not have lost my policy, but you didn't do it that way. And finally, after like I knocked down every one of his little objections, he just said, Chris, I designed it that way because I couldn't afford to cut my commissions. I said, well, at least that's the truth, but I'm not going to send you any more of my friends or family again because I'd sent him lots of business. Well, at that point, I kind of decided to take it on myself. And the crazy thing is, like every time I see in that space, the one thing that's the biggest problem is that you hear all these different perspectives. One, they tell you it should be like a bill pay account. No, it's not. I've ran the numbers. It's not worth all the time and effort. You will lose more money and lost opportunity cost in your business or your real estate than you will trying to save a few bucks in interest using this as like a bill pay plan, right? Secondly, they tell you you pay yourself back, right? Yeah, you borrow your own money and you pay yourself back. First off, you don't borrow your money, you borrow it from the insurance company. You pay them interest. You don't pay yourself interest. This is not a 401k that way, right? You are literally paying them interest. The reason that they make it like a half truth is because the truth is that your money's still there earning interest. Like, for example, say you have 100,000 in cash in this tax-free savings account in there, right? And you want to borrow 50,000. You don't actually touch your own money. Your money, 100,000, is still in there earning tax-free interest. Right now, they're paying roughly about 6% a year tax-free. But you're also paying them roughly about 6% a year to them for interest, right? So when you're paying back the money, you're paying the insurance company interest just like they're the bank. So don't let anybody tell you you're paying yourself back. Yeah, you might pay yourself payments and you're paying down principal and interest. But here's where it's really cool. Here's where the double dip thing comes in play. And I teach this a lot with investors is that because you're paying back more than, or you're paying back at least interest only, you only get charged simple interest while they pay you compounding interest. Because, for example, you have $100,000, you make 5%, you got 105,000. Well, the next year you make 5%. Now you have 110,000 and 100 bucks, right? You make a little extra, next year's like 115 and extra, right? And so on. But on the loan side, because you're paying it back, if you pay it back, you could let it compound against you and then you lose. But if you're
Right.
actually paying back with a cash flow and investment, like say you had that 50,000 generating 500 a month from your investment, you're using that $6,000 a year, you're paying back principal and interest, you're paying the loan balance down, which means you get charged less and less interest while you compound more and more interest. And there you make a net profit on your interest. when you do it that way. But if you don't do it that way, and the nice thing is, at least you don't have to make monthly payments. But if you do it that way, then you actually get a net gain and you're still making money from your investment, meaning you double dip. But that's the thing that's so confusing because they'll make it seem all this overly complicated. They'll throw you all these formulas and stuff. But the truth is, it's actually much simpler. But don't for 1 second believe you're paying yourself back interest. They just tell you that because they're trying to sell you more crap. Here's another myth for business for real estate investors I see all the time. Often it's pitched. It'll say, "Hey, just dump in a ton of cash up front and then pay very little on the back end." Well, that sounds nice in theory, but the problem is this: the more you dump in up front, the higher the death benefit has to be. So one thing that we do differently is the reason why ours beat everybody else's when it comes to the numbers and having a better ROI is because we minimize the death benefit as low as we can get it while keeping it tax free. So where a lot of those guys, they'll say, well, dump in a ton of cash. Well, to dump in a lot of cash, you have to have the death benefit higher. That's the IRS rules. The higher the death benefit, the more you can dump in. Well, so if they're saying, well, rather than paying, say, $25,000 a year, just dump in $250,000 up front and then pay like $15,000 a year thereafter. Well, the reason they tell you that is because they get paid the bulk of their commissions up front. The insurance cost is how they make their commissions, right? That's where you're getting ripped off. I had one guy, literally, he was a real estate investor. He's like, yeah, I was told to put in $750,000 and then pay $250,000 a year. I said, watch this. Watch if I just did $250,000 a year, your death benefit shrinks by 2/3 into a third of what it was before, meaning your costs are now a third. And therefore, now you have a higher ROI because less money's coming out in costs. You actually break even and make a faster ROI. In fact, by the third or fourth year, it's paying for itself anyways. You don't even have to keep paying if you don't want to. And he's like, oh, that's much better. I'm like, yeah, the 750,000 makes them a killing, but it makes you less.
Well,
So
let's
beware of like the dumping.
let's pause there for just one moment. And we probably should have
Yeah.
started with this in the beginning. A lot of people are not familiar with the infinite banking concept. So
Uh-huh.
just give us like the really quick high level overview of what it is and how it works.
It's basically using a whole life insurance policy. Whole life is different in term. Term is just death insurance. It has a death benefit. Whole life has the death benefit and it has this tax-free savings account inside of it called cash value, right? And so infinite banking, what they try to do is that cash value, not the death benefit, but the cash that's in there, eventually, because all these fees are coming out and stuff, eventually you have some cash in there you can start to use. And they'll say, well, go and finance your own house, like buy your house, and so you pay yourself back instead of the bank, buy your own cars. Here's the thing, from an investor perspective, that's a bunch of BS because yeah, I could do that. But to me, cash is everything. And you know this too, because you're a passive investor like I am. You want the cash to generate income. Well, if I can get cheap money from the bank for a mortgage or for a car loan, I'm going to do it, right? Because if I know that I'm still paying interest to the insurance company anyways, why not just get the money, bank's money, pay them the interest, and then I keep my money free to be used as a down payment for a property or to go into a syndication or into a fund or something like that where I can make interest off of it instead. That's the thing because they're insurance agents. They're just thinking like Dave Ramsey-ites, right? Which they suck. You got to think more like someone who's an investor. And that's why I like to use this more as cash reserves where I can keep my money and real estate and creditors, creditors and any lawsuits cannot touch this money in most states. You could have millions sitting here. They can't get to it. They can get to your savings accounts, even your IRAs. They cannot get to the cash in here. And two, it's tax-free. So it's like a tax-free supercharged savings account that earns more than 0.nothing% in the bank. But I can also use it to invest too.
Yeah, you know, it's funny. The gurus out there, the infinite banking gurus, will say, "Oh, yeah, you can borrow money from your cash value of your whole life insurance company or policy to buy a home." And I've always been like,
Yeah,
"Yeah, but mortgage rates are cheaper than that. Like you can
exactly.
borrow cheaper interest from a traditional bank or lender." So
Yeah,
yeah, I mean, some of that's never really made sense to me. And what you're saying makes more sense, where there are some things that are going to charge you a lot higher interest to borrow on. Homes are particularly cheap to borrow against, but
yeah,
you know, borrowing flexible money for down payments on investment properties, for example, it's a lot harder to borrow, uh, a down payment for one of those. So,
yeah.
yeah, I don't
Borrow
make
money for things that they won't give you money for, like the down payment, whether it's
exactly.
20% down payment, the 3%, 3 or 5% if you're doing like a BRRRR strategy or something like that. Like, yeah, like you use the money that they won't give you money for, you use that money for that. Leverage the bank for everything else.
All right, I've got one last question for you about this that never really made sense to me. Is that you've got a
Uh-huh.
lot of the gurus out there in the infinite banking space who say, oh, you don't need Wall Street, you don't need stocks. All you need is your infinite banking plan. And then they'll also say, well, it's not really meant to replace investments. It's meant to replace your banking, your savings account or your
Uh-huh.
checking account. And I'm like, well, which is it? then you do still need Wall Street, right? I mean, you do still need the investments that are actually paying, an average of 10% a year or whatever, if this is just replacing your bank accounts. So walk us through that. What's the relationship there between your investment accounts, your banking accounts, and where infinite banking fits in all that?
Yeah, you need both. You really do. Because you're right. Like I've run the numbers any way possible, and my numbers beat those guys' numbers. And still, I tell people all the time, you will never become financially free just off your life insurance cash.
Right.
Like the returns just aren't big enough. Like even if you net 5 or 6% a year tax free, that's great. And it can provide a supplemental retirement income. You'll hear them use that word all the time, right? Because it's true. You really can't retire well off of those things.
Right.
So that's why I always encourage people like, no, buy your real estate, do your alternative investments, do that, but use this instead as a place to store your cash, right? Like I use this to unbank myself. Banks, I mean, just rip you off, right? I mean, they pay you very little interest. Even high yield savings accounts don't pay that well, and you get taxed on that money. Where I can store my money, earn higher interest than the bank, and it's tax free. I can store it here, and it's protected from lawsuits of creditors, right? So for me, I store a lot of my emergency reserves. I keep here because I can make more than the bank. And then two, even for cash that I may want to have to build my war chest to invest and do other things, I can use there too. I still use banks. I still use banks to go get money quickly, like same day type stuff. If I keep my money in the Infinite Bank, it takes about a week to get it before it transfers to your account. So I plan for that. But my wife wants $400,000 sitting around that we don't invest. I told her, I was like, well, why don't we keep 300,000 in the Infinite Banking? That makes at least 5% tax free. That's 15,000 a year versus 0.1% at the bank, you know, and then we keep the other 100,000 in the bank that we can access and use whenever we need it, right? Same thing. So I use that way, but I still invest and do everything. Here's the crazy thing too. When I have people fund it in those first few years, I don't have them use their investment money. So there's not that competition. I say, get the money invested. You got $250,000, get it out there, invest. You make 10%, make 25,000 a year. Cool. That can help pay for your premiums for your policy. In the meantime, just use your emergency fund for the first couple of years to fund the policy. So you're not using any of your investment money. You can still make the cash flow there. And then that starts to build and grow it faster to where then it's almost like a zero net cost for you.
Yeah, no, so that makes much more sense to me than the way it's been presented in the past, where the
Mhm.
whole infinite banking concepts, your whole life policy is one piece of the larger puzzle. It doesn't replace your stock investments, doesn't even replace necessarily your traditional bank accounts, like you said,
Definitely not.
but it's another piece of the puzzle. You get some of that stable, tax-free interest. Uh, yeah, so that all makes sense. Chris, in 30 seconds or less, how do you help people and how can people connect with you if they want to take you up on that help?
Yeah. I mean, we've got like the Money Ripples podcast we do, of course. We got moneyripples.com. We help everybody from designing these infinite banking policies to get the best ROI possible in their situation. We even do like passive income consulting as well that we help people with too.
Awesome. Well, Chris, thank you so much for joining us today. And guys, if you enjoy these quick hit conversations that we have, please rate, review the podcast. It makes a world of difference to us. And we will catch you next time. Wondering how private equity real estate investing works? We get it. A lot of investors are put off by phrases like private equity or real estate syndication, but these completely passive investments are actually a lot easier than buying properties directly, buying properties yourself in your own name. So we offer a free 40-minute class called Hack the Rich, 7 secrets we've learned from private equity real estate. There's not even a sales pitch at the end. We'll show you how to invest in these on your own without any help from us. So go to sparkrental.com/hack to take the free class. And we can't wait to chat about your questions.